Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. With the devastating second COVID wave having come down to between 30 to 40,000 fresh corona cases in India per day, India is now almost out of the lockdown mode and economic activity has been limping back to normal with the lifting up of the lockdown and the corona having subsided a little for the moment. Demand has picked up, so has production, so has supply and growth, and so has the Indian economy gathered steam with the easing of these bottlenecks by various states. In addition to this, a recent report also says that there has been a significant improvement in the state of government finances, with the fiscal deficit of India being at an 8-year best for the June 2021 quarter of the current financial year. There are random dots of pickup in economic activity in India without any true defined pattern. But then, after the lifting of a lockdown, economic activity is bound to pick up. But that need not necessarily mean that such pickup in economic activity will sustain itself and continue for the coming quarters. The fact is that durable growth needs to come back to our economy, and the government too would want us to already perhaps believe that durable growth is back in the economy. The favorite statement of government mandarins, which has turned out to be a false dawn each time, is that a V-shaped recovery is taking place in the Indian economy, and we have seen every time that it has not been so. While we do see nascent early signs of growth due to the lifting of the lockdown, the question, however, is whether it is back on a durable and sustainable basis or whether it will wither away, like we saw in the aftermath of the second wave when the pickup in economic activity proved to be short-lived. Let us look at a few reports and connect the visible dots to see the emerging picture in the economy, if at all there is one that can be made out to be. A recent Nomura report has been very upbeat on the ongoing recovery in the Indian economy. Nomura says that the weekly business resumption index of Nomura for India has already crossed the pre-pandemic level of 100 for the first time for the week ended 15th August 2021, and now the index is at 101.2, which is more than the pre-pandemic index of 100. Nomura notes that the Google mobility indicators have gone up, including the workplace, retail and recreation indices. It then says that power demand has gone up by 5.7% over a week, and the labor participation index has dipped slightly from 41.5% to 40.4%, which shows an increased engagement of labor, particularly in the manufacturing sector, implying that more work, more jobs have come back, showing an uptick in growth. Nomura then says that recovery from the second wave has been swift. It took 10 months for the Nomura index to touch the pre-pandemic level in the first wave, but it has taken just less than 3 months in the second wave now, and it has already touched the pre-pandemic level of 100, as it puts it. It further says that the Indian economy is not yet out of the woods, yet the current dynamics, according to it, support its GDP growth rate forecast of 10.4% for the current financial year. Just to remind you, the forecast of current year's financial growth by RBI stands at 9.5. Nomura puts it at 10.4. Nomura says that high-frequency indicators in the economy have shown relative resilience, with freight movement and merchandise exports at pre-pandemic levels, and there being clear signs of recovery in automobiles, electricity generation, and the core sector output. Yet another report is related to the finance minister. In her recent speeches and press meets, the finance minister has emphasized that the Indian economy is recovering from the challenges of the second wave. She says that the Indian economy is now buoyant and recovery is very clear in the economy. She then says that exports are growing and that steel and certain core sector industries have themselves said that growth is back in the economy, it is back in their sectors. The core sector growth of about 8.9% was largely due to public capex, according to the finance minister. She then says that infrastructure investments by the government are at one of the highest in India's history, to say that the government is pumping up the economy. The private sector is coming out in a big way, according to her, to show keenness to expand their manufacturing program, implying that fresh investments by the private sector are on the table. The government capital expenditure will not be reduced, she says, and that only wasteful revenue expenditure is being cut by it. And she finally says that the government is ready to do everything to revive and support economic growth. India will take measures to contain inflation and growth will be a priority in the current environment, according to statements made by the finance minister. Yet another indicator of growth comes from the fact that at $95 billion, the exports from India during the April to June 21 quarter have been the highest ever, recording a year-on-year growth rate of 85% between 2020 and 2021 and a growth rate of 18% as compared to financial year 1920, which is a better figure to compare with. The sectors which particularly saw robust international demand and exports were petroleum, gems and jewelry, engineering goods, and agricultural products. If these are the positive dots of growth on the economic horizon, then there are many negative ones too, according to us. We see a patchy scene and a fluid situation. These positive dots do not lead to a conclusion that all is well across the board in the Indian economy. The recent Consumer Confidence Index survey of the Reserve Bank says that current consumer confidence in India remains at an all-time low, with most households reporting lower income and a higher level of prices, which is they are battling inflation. The Reserve Bank survey says that consumer expectation of increase in income in the near future has worsened from minus 15 May 21 to minus 15.9 in July 21. The consumer expectation of spending on non-essential and discretionary items too has worsened, not only for the present according to the RBI survey, but also for 1 year from now. Most respondents to this survey think that the current inflation is high and will remain so for 1 year on. That was Reserve Bank's survey on the dipping consumer confidence. Yet another RBI survey on order books, inventory, capacity utilization and supply in the manufacturing sector reveals a marginal improvement in capacity utilization. There has certainly been an improvement in demand after the abatement of the pandemic and the easing of the lockdown, but it has not been impressive or inspiring enough according to us. As would be expected, the present signs of growth are mixed and patchy. After all, a deep uncertainty continues to prevail about the very return of a COVID wave and a likely lockdown. A third COVID wave would mean a lockdown, and it would mean that economic activity goes down again. A number of risk and restraining factors are at play, and it would be unrealistic to expect a sharp and steady growth. And these factors, which is the risk and restraining factors as we call them, explain why it is too early to proclaim the return of a durable and sustainable growth in the Indian economy. These factors are many. Let's discuss them. The first one, a surge in growth is always witnessed after the lifting of a lockdown, as we saw in August and September last year. A pent-up demand after the lockdown is a temporary upsurge and can soon fizzle out if there is no solid foundation to sustain and continue it. That solid foundation is the willingness, ability and appetite of the consumer to spend, which has not yet returned, as is very clear from the recent consumer confidence survey of the RBI that we discussed. Household income and household savings have dipped. Until they are not restored and refilled, the demand build-up that we are seeing at the moment can certainly fizzle out. This pent-up demand of July 2021 will be followed by a festival demand commencing from the ensuing Ganpati festival, and it is too early in the day to predict the strength and continuity of the demand after the end of the festival demand upsurge which is going to take place. Thus, the demand at the moment is to be taken as a pent-up demand, as a temporary demand, and it's too early to see where the trend will be. The second factor, corporate spending remains subdued and corporates are still unwilling to risk capital in new investments. A recent report says that corporates are worried about the adverse impact of inflation and commodity prices on their sales and profits, which will restrain corporate investments and spending, which the government expects them to do. The third factor, while the FM speaks about the government's commitment to public capital expenditure, much needed to trigger and support growth in India, the fact, however, is that it was below the mark in the June 2021 quarter itself, because of which there was an improvement in government financials that we discussed. The finance minister wants the corporates to start investing, but for that, it is the government that will need to start first and lead the way to inspire the corporates in the private sector to do so. That is the need of the hour. Until the government capital expenditure does not visibly pick up pace, the corporates are bound to sit on the fence. The next factor, inflation remains elevated and it will curb consumer and corporate spending. The uncertainty and fears of a third COVID wave remain, and if it returns, then the contraction of growth will be more likely than any expansion in growth. Major producing states like Maharashtra are already wary of its return and are speaking of an imminent lockdown in case a third wave comes back. Till the jobs do not come back, the fortunes of the MSME and informal sector do not improve, and bank lending does not escalate, there will be no sustainable trend in growth in the Indian economy, in our opinion. To us, at the moment, the dots do not connect to a picture of dependable and continued growth. And the larger picture, according to us, is that there is no confirmed large picture in the dots that we see at present. They are random dots, they are a lot of mixed dots, some showing some kind of a growth, and many others saying it's time to wait and watch. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, subscribe to our YouTube channel.